Hello there, I'm Miranda Carberry-Brown and I work in PwC's risk consulting practice. I'm delighted today to be joined for our Risk Mind session by Colin Church, Global Head of Climate Risk and Crisis Risk Management at Citi. Hello Colin, thank you so much for joining us today. How are you?
Good afternoon, it's a pleasure to be with you.
Fantastic, fantastic. So I'm going to take you through a couple of questions around climate risk and your experiences in what can only be described as an unprecedented year. So I will dive straight into the first question. So Colin, as Global Head of Climate Risk and Crisis Risk Management, I can only imagine what a year you must have had. Can you walk us through some of your experiences?
Well, thank you. I started this new job, which is pretty unique, but I think you'll see more of this at other institutions. I started in early February, and I got to say it started with a bang, as it did for all of us in that period of time. Obviously that was the COVID crisis that really came upon us as we rolled into in this region, which is Europe, in March. The first order of business as we were focusing on this was obviously crisis management at a previously unprecedented scale.
Yeah.
And when you think about crisis management, we've developed a playbook from a variety of experience around this. The first thing you think of is taking care of your people, as did I think everybody in the industry. We had a little bit of advantage in that we had a very significant presence in Asia, which gave us a hint on some of the practical issues we'd have to think about. And I recall as we were having board meetings and most senior management meetings at the time, we were already gearing up and saying, well, if this ever sort of jumped to another level, namely Europe or the US, it would be a whole different thing. So I think some of the things that immediately came out of that as well, in addition to how you would manage people, and that's more at a regional or a country level, and there would be unique considerations around that, was really this was the ultimate operational resilience scenario. I think a lot of people had plans and contingent, continuity of business thoughts around what we would do in a particular country or a particular infrastructure. I don't think anybody had foreseen an event whereby you would be hit concurrently in all your jurisdictions, in all your country, in all your businesses, or would have represented themselves as being confident they would be able to stand strongly against that. I guess the good news, and one of the learnings was, given where technology had progressed to, and I would say literally over the last 5 years, the system stood up very well. No one would have imagined, I would have said, you would have been able to, on a 1 month standing start, no practice, no hints, be positioned to run your bank with 5 or 10% of the staff in the office. And that went very well. The second order issues that we, in risk management really started to focus on were the obvious volatility, market volatilities that came out of a broad-based lockdown, which was, again, very much a game changer. So we saw tremendous volatility in our counterparty credit processes, our market risk processes, and then ultimately our loan portfolio, because, again, there was no precedent whereby you would have had within a 2-week period, and I remember it vividly as we were having discussions with boards around loan reserves, et cetera, that you would have a 10% adjustment in forward-looking GDPs and forecasts. There was nothing like that in the previous crisis or any crisis anybody could remember, or historical for that matter. So that was a new set of challenges. And again, there was a lot of thinking going into, well, the traditional toolkit we would use is based on financials and a 3 to 6 month lag process, and very much trying to get the organization and all our people thinking forward, very dynamically about what this new world we meant. You also had a sort of question on climate risk, and I'll be brief on this one, but it was also sort of an interesting series of developments, because there was initially some uncertainty. Would that go to the back? It had a lot of momentum last year, but would that go to the back burner in light of these huge, unprecedented challenges? And ironically, or the result was just the opposite, that a lot of people within our industry, but also in the public policy business, very much linked it to COVID and viewed this as just another fat tail risk that society and we as an industry had not really put enough effort into addressing. So that's that agenda's come back with a renewed vigor. And then you're also seeing that again, as I said, in the public policy arena, where an unprecedented amount of social support and financial assistance going into markets is being very consciously directed, notably in Europe, but you're also hearing this theme in the UK and the US as well, about deploying this capital in the new world business model or building back better. And part of that is an environmental and a climate risk agenda of, again, unprecedented substance.
Absolutely. Nice. So many points covered there. But I guess on that, following on, how have your experiences of the pandemic, in your view, changed your view on best practice crisis risk management?
Well, a couple of high-level thoughts. One, in a positive way, it affirmed a lot of the work and the infrastructure that went in post the previous crisis was a very good investment. One, in terms of the credibility and the quantum of capital in the industry. This was not a financial crisis for that reason. People trusted their tools. The regulators were confident in the early stages in the way they were positioned in describing the banking system. So that was very important and very helpful. I'd say the other thought that sort of came out of it to me as well was it also validated the current focus on the operational resilience agenda and a number of specific things. So as we were crisis managing, that protocol of one looking very much, at an institutional level at our critical assets. There's also a systemic corollary where governments and cross-border and supervisory authorities had also been thinking about that for a long time. Yeah. So that toolkit and that focus, really came to the fore and made a lot of sense of keeping the most fundamental processes open. And in fact, we were able to keep the full suite of processes open throughout the process, which was good. The other one that was, evolving in the operational resilience space was a presumption of failure. You would take any critical infrastructure, any process, frankly, even any large institution, and start to think about just the lights went out and you don't know why. I think that discussion really developed out of cyber, but there could be many things that could cause that. And there were certainly some instances in the COVID progression where that did happen, and the world adapted pretty quickly to that. But again, that validated that makes a lot of sense. It also sort of points to an end-to-end process focus. So what is that social outcome of that potential disruption, irrespective of where it comes from? And again, that would have focused the mind very quickly on how you develop that thought process and how do you triage if you had to. And then lastly, I think another one that we've been focusing on as well, as an industry is better understanding the supply chain linkages and critical dependencies on common infrastructure. So those always came to the fore. And then I'd say the last thing that it's also, this will take time, but it's also very interesting, is our traditional credit processes and how we think about reserving are potentially in such a hugely dynamic environment. And I know the world's regulators are very focused on this. The industry came out very aggressively and at a very early stage in a period of tremendous uncertainty with unprecedented reservings. And to date, those have tracked pretty effectively. So again, I think there'll be a lot of lessons there, and we can all benefit from. And in effect, proving our models under extreme circumstances that nobody would have actually foreseen.
Absolutely. And I think that lessons learned piece is very critical. If I may move on to climate risk. So obviously part of your remit, and it's been on the radar of most businesses for a few years now, but it's clearly grown in importance. What long-term trends should be on financial institutions' horizons when it comes to climate change?
Well, this has been much discussed, and I know a lot of people are focusing on this. So it's nothing new to say that we should all understand the underlying transitional and physical risks of not only our own institutions, but the clients we bank. As you know, this is a hugely complex and ambitious undertaking, but I don't think anybody's disputing that this should absolutely be a top risk, rather than just an emerging risk at this stage. I think, again, this is as much about really understanding your client base as yourself. And so this is a journey we're going to have to take together, as common cause with our clients, because banks will ultimately reflect what their clients are in terms of their carbon footprint, in terms of their ability to transit safely over the next couple of decades. And common cause with the supervisors and regulators. This is a top G20 focus, and we're all linked. And again, it's one of those things, a little bit like the operational resilience agenda I was talking to earlier. It really does feel common cause, with our peers, with our regulators, with our social constituencies, as to how we in effect build a better collective toolkit for truly understanding these risks. And again, this isn't just about risk management. There's a great opportunity here, and perhaps an unprecedented one, for banks to very positively influence the social agenda by our ability to develop those technical tools that everybody desperately needs to manage this transition and help advise clients, as well as deploy capital in the most effective way over a much longer term than historically traditional risk management focus has been. And I think I'd leave it on that note too. Is the interesting challenge here is historically market risks are very short term. Typically, a lot of our counterparty credit or even loan credits are typically in a very relatively short horizon, i.e. 1 or 2 years or so, in terms of average duration. But in this instance, we're all going to have to think over a much longer term horizon and really be quite strategic about how that's going to affect our franchise and our clients, and how we all evolve together through these very notable challenges.
Absolutely, absolutely. And I guess staying on the topic of climate risk, as you well know, climate risk is often linked to ESG. ESG implementation and indeed integration is key now. So in your view, what are the barriers and how can we overcome them?
Well, it's a tough topic. ESG doesn't fit tidily into existing, risk management or governance frameworks. And all of those are a little different, the E, the S, and the G. So maybe I just speak a moment to them. Climate fits firmly in E, but E is broader than that. One that people are very focused on now is biodiversity. In addition to that, there's a lot of focus on that, and so I won't spend some time on so much time on that one. That's a key component, and ultimately may well be the dominant one. The S is a little trickier because that tends to be a pretty bespoke process. We, and I think others have, big banks have been afforded the luxury of setting up risk management processes and groups who focus exclusively on this. But these will be company-specific, country-specific, project-specific assessments. Very complex, but the world continues to develop pretty clear criteria about what acceptable behavior is. We all contribute to those conversations really on a voluntary basis. But then that's, the question is then how do you integrate that into your traditional governance and risk processes? And we have some form on it, but I think now, there's an opportunity to go the next step on that. And I think that in the governance question will always be judgmental, and to touch on governance as well. That's nothing new to risk management. That's nothing new to credit assessment. People would argue, I was on a call with a number of fellow CROs the other day, where, many of them were suggesting this is what we've been doing in our fundamental credit process for a long time, but that is true. But there's also an opportunity to enhance that with, a more modern set of tools, in terms of potential AI applications, assessing news articles, et cetera. And this ties into fraud and a variety of issues. But really what we're focused on is giving our risk officers the full suite of toolkits and the cutting edge information they need to ultimately make that human judgmental assessment that incorporates all of these considerations. And, it's still going to be too complex to completely put into a machine and AI, certainly over the next few years as we continue to develop these tools.
Absolutely. No, thank you so much, Colin, for your time. And I like your reference to toolkit and the fact that this is not just a one-time solution to what are quite complex climate risks and general crisis risk management pieces. So I think there is a piece around that toolkit needing to be utilised to full effect. And for everybody, this is for everybody to kind of contribute to. It's not just an isolated risk issue.
Yeah, and if I just one last comment on that, and that probably is the interesting one for this group, is I think the risk profession really does have something unique to contribute to this in terms of the analytic talent, background, mindset, and how you link that to governance. Because one of the things that became very apparent to us as we started on this journey is this isn't just about risk. This is about how do you equip your bankers to advise those clients and help them with their challenge, right?
Absolutely.
Giving them the framework and the tool. How do you help your investors on the other side of the equation really think about that in an analytic and a systematic way? And then how do you align the whole system? And this would include supervisors, central banks, industry itself on those similar taxonomies, hierarchies, and analytical tools that help us really build a better process and a better system.
Thank you so much, Colin, for speaking with us today. You've shared some great knowledge and insight into life as a global head of climate risk and crisis risk management and what can only be described as an unprecedented year.